Hello and welcome to another edition of Nucleus Investment Insights. This week we're having a look back at oil on troubled waters. We've seen the oil price ran up quite significantly a few months ago, and we talked about it then. And since over the last few weeks, we've seen some quite significant falls. There's a number of negatives we're looking at, and one or two potential positives. But I thought it was well worth having another look. And so we have Dave back as well to talk to us about this. Just a quick reminder that anything you hear here is not personal advice. It's all general in nature. If you do want some personal advice, give us a yell. We can talk through that in more detail. And with no further ado, welcome aboard, Dave.
Hello to Damien and listeners.
Right, so oil. We are looking. Let me bring up some slides. And we've got, sorry, I'm going to prepare myself a little bit better. So, looking at OPEC, implication for oil price, and then I guess the big macro thoughts and in particular inflation, what's going on there. So OPEC, Dave, the announcements out last week.
So basically OPEC shocked markets over the weekend with a hedged commitment to unwind some of their voluntary cuts from later this year. They're pretty substantial. It's over 2 million barrels per day, predominantly from Saudi Arabia. And that's kind of 2 years worth of demand growth that they're looking at bringing back on stream. So it is quite material. Now, the thing about these kinds of things is, this may play into what's actually going on, is although it's not until Q4 that these things are really going to happen, if you signal to a market that you're going to do this, even in a hedged manner, then it's going to price it long before you get there. Once it sees oversupply on an investing horizon, and Q4 is that, we're only sort of 3 or 4 months away, then it's gonna reprice you ahead of time, which is what we've started to see in Brent and WTI, following this with some very heavy falls. The question is, I can't believe OPEC doesn't understand markets to this extent. So, what is it up to here? There's a number of factors that play into the decision. First is some of these cuts were never made. There's been a lot of cheating, which is probably really driving Saudi Arabia nuts.
And when you say cheating by other members of the OPEC cartel?
Yeah, other members of the cartel have been pumping oil above their quotas, and of course it's held the price high, and so non-OPEC oil has just been going gangbusters, including in the US itself, where shale production, although wells have been falling for some time, has continued to ramp up, and some other jurisdictions as well. So it's the old commodity story. If you want lower prices, just wait 5 minutes with high prices, and if you want higher prices, just wait 5 minutes with lower prices. And this is kind of what drives commodity markets. If you because it's a commodity that is it's available everywhere, it has no intrinsic IP or moat to it. It's basic materials that are available all over. Then if you offer high prices, you'll get supply before very long. And
and what's I guess also different compared to even 15, 20 years ago, or maybe not as much as 10 years ago, but the amount of shale oil that's on there, and they've got very fast turnarounds for a lot of those wells.
Exactly.
Whereas go back 20, 30 years, if you had high oil prices and somebody needs to bring on capacity from wells that they might have had partway through production, you're talking years before you can get some significant amount.
That's right. And so in most commodities, I don't think oil's any different, although the dynamics are a bit different, as you say, with shale. They're all fundamentally oversupplied, all the major commodities, in my view. after the China structural boom. And if you lift prices, then you will get a supply response relatively quickly. So anyway, Saudi Arabia's been watching itself lose market share. It's been running oil output well below potential, like I'm talking 20 to 30% below. And it must be very frustrating for them, given this is essentially in terms of the duration that they will be thinking, it is essentially a stranded asset that they're leaving in the ground. So, they need to get it out and need to get rid of it as soon as they can.
But as you said, like it's interesting though you say that, because I mean, from a if you took a purely dispassionate view about it, it's saying, well, okay, so if I cut my own oil production back, whatever, by 2 million barrels a day, so 20%, but prices are probably up 40 or 50% from where they were before, is that they're a net winner from that. If you're talking about $50-$60 oil and now you're talking about $80 or $90 oil, they are better off. But the problem is there's all these free riders, as he said. Like now it's we're meant to be all in this together, guys, but everyone else is taking advantage. Everyone else is going, well, I'll keep producing 100% and I'll get the 50% increase in prices. Whereas that's really a
So I do think that's probably some of the reasoning for the Saudi decision, those dynamics that you're describing. But there are two other obvious potential drivers to the timing of this. One of them is obviously the conflict in the Middle East. And do we think that Saudi has done some sort of deal with the Biden administration behind closed doors? Nothing to suggest it has, but US rhetoric on Israel has been stiffening of late. This is as Israel bombs away at Rafah, and potentially a war in Lebanon, as well as the sort of fast approaching US election. Saudi Arabia made a calculation here that it would rather deal with the Biden administration than Trump. Hard to know, because
or it might be making a calculation that based on the conviction of Trump, that maybe the odds of dealing with the Biden administration are now higher, and so they need to make sure they've got both sides.
Yes, or they're covering both. It didn't seem to deal with the first Trump administration. Okay, the Saudis, like they kind of bribed their way to influence. So these are all sort of unknowns, or known unknowns, I guess, but they're almost certainly playing a role in some way. So anyway, I mean, if that being the case, we're really looking at this being a new regime at least for the next 6 months until the election, and from there, who knows? Depending on the election result, things could swing. Or okay, give me a few minutes. Forgive me, everyone. That's my 8-year-old daughter telling me she's hungry. So this gets us to the end of the year. So, where is oil going to go if this new market share regime prevails? Then, Saudi Arabia really needs to see US oil peter, at least flatten out, if not start to fall. Now, US shale is not quite as competitive as it was a few before the pandemic, but it's still pretty reasonable. And your sort of marginal barrel in the US is about $65 these days for a new well. So if we're going to see a squeeze on non-OPEC oil, and in particular US shale, which is the swing producer, as Damo said, because it can come on so quickly and disappear just as fast, that's going to mean about $65 for on WTI, so 68 Brent. This is the pressure point for US shale, roughly speaking. Now my front door is ringing. Anyway, these are the travails of the modern
home podcast,
the modern economist and podcaster. So there's still some downside potentially to the oil price, and that seems to be the base case. I don't think OPEC is silly enough to make a mistake on these things. So I'm assuming that, that there is something of a shift here, and that's the kind of pricing that they'll need to deliver what logically they would be after. So shifting gears to what that means for macro, obviously you don't need to be Einstein to understand that.
Actually, sorry, can I just add? There's one or two other ones I sort of thought worth adding in, just in terms of the influences. Is Chinese electric vehicles are certainly booming in terms of the production of them, and the prices. There's a whole price war going on, and prices coming down, and while there are sort of tariffs being put on around, and demand for EVs is not as high as what I think production is, certainly the demand still is growing, and I think that's probably factoring a little bit, at least, into some of the decisions as well, in terms of it being, well, at $90 of oil. I would argue in most countries EVs are still not sort of break even at that point, but they're closer than what they are at $70 oil, and so it's just that's the higher the oil price, that accelerates that, and I'm sure that factors a little bit into the calculation as well. Whereas 5 years ago, while we knew the EVs were coming, I think there were certainly a lot of people who were sort of very, very skeptical, and they'll never do it, and the EVs will ruin your weekend, and all that type of stuff. And so what you would see is, in terms of that, is you'd say that we can now see the whites of the eyes in terms of what's coming down the line in terms of electric vehicles, and we can now see that if we don't actually from the oil producers, it's a lot clearer to them what's coming there. That's one part, and the second part is we spoke about it last time we were talking about this. Is that the Ukraine? One of the reasons why the prices had shot up in the prior period, or sorry, a few months ago, was that Ukraine had started targeting Russian production and Russian refining, and that was what was I think that one stage of sort of 15-20% of Russian capacity was offline, and so and then there was a bit of a pause in that, and the US in particular was talking to the Ukrainians about and putting out messages to the Ukrainians as that maybe you shouldn't be targeting Russian oil infrastructure. So there has been a little bit of that recently. They've sort of started again to target some of the infrastructure. I wonder if it's going to be a little bit more nuanced, and with that same part that they're keeping an eye to US politics, and that they sort of they'll practice on a few sort of the more close and the more local ones, and then once the election gets closer, or and particularly if we see a Biden win, that you might then see the sort of retargeting of Russian. So I guess a lot of the stuff we've spoken about geopolitically is all sort of pointing towards a lower oil price, whereas that's the only one I'd say is that's the major one we could see as well. If they do decide to ramp up before the election, that could sort of see the oil price swing back the other way. I'm not sure if you got any other upside risks in your book, David, other than I guess a more of a full scale war breakout in the Middle East.
Yeah, that's the main one. Obviously, is geopolitical risk, and I guess within that, some kind of escalating conflict between Israel and Iran is the major worry. But I don't have a particular insight on that. Just that it is there as a risk to the disinflationary oil trend that we're seeing at the moment.
Yep. Anyway, so jumping to macro.
Yeah. So I mean, this is pretty. We called this oil on troubled waters because it's pretty good news for developed economies as they plod through this last mile of squeezing out inflation. I've given you a chart here that if we do get to WTI $65, we'll be looking at sort of 20 to 30% downside on oil within a couple of months year on year, which will certainly aid in the fight against inflation. There are a number of other implications from falling oil as well that will be useful to central banks. Most of the global LNG probably around 60% is still priced on an oil price slope. That is, contracts are determined. Contract prices are determined by a percentage of the oil price, typically Brent, and so this will tip into the European story very much with its shift away from Russian gas and towards US LNG and LNG in general, which will be very useful to the ECB. If we get down to this sort of $65 or $68, say, Brent oil price, and if you chart oil versus your global inflation trends over the last 20 or 30 years, they're very closely correlated. So anytime you're going to get big oil disinflation, it's very useful to your inflation fight. So that will be most welcomed by central banks, including in Australia. Excuse me, and that that offers you a series of implications for macro. If you're going to see that kind of oil price easing, then you will see yields come off, which will reduce the tightening by central banks and encourage some rebound in consumption, etc., in developed economies. And so, generally speaking, I guess it tips into what is still, I think, the predominant narrative in markets, which is a soft landing versus, either a hard landing or no landing. I think oil falling back to, say, 68 Brent would certainly boost the soft landing case. And with its marginal boost to consumption and further disinflation. So it's a good news story on that front. For Australia, it would more typically, it would probably be even more so in Australia. Not that we particularly use more oil than elsewhere, but the Australian dollar will probably rise if oil came off that much. Because it tends to drag down the US dollar these days, because the US is an oil producer. And so you'd get an even more exaggerated pullback in the oil price in Australia if you've got a rising dollar and falling oil. And that there is a tipping point in that. You wouldn't get, if other commodity prices started to fall along with oil, especially bulks like iron ore, etc., then there's a tipping point at which the Australian dollar would start to fall as well. But I think in the initial stages, maybe down to 60 to 70 or 68 Brent, you probably get a rising AUD. So it's even better news for Australia in that sense.
Well, and also on the if you took the view that the Australian energy market consists largely of the local cartel, a local gas cartel, just taking as much as they possibly can until people squeal. If you see international prices fall, then the level at which people locally squeal potentially comes down as well, and they need to keep prices.
Yeah, well, the LNG story. This is the sad irony of Australia's LNG exports is the local economy tends to do better when they fall, when that price falls, and so that's another marginal gain for the Aussie economy if oil drags down LNG prices, assuming spot prices fall with contract, which they probably would. You get some price relief through both gas markets and electricity markets. Some price relief there. So that's a double bonus for Australia if oil does come off, and you might want to talk to your local MP about why that is the case, that our LNG exports are actually damaging our own economy. And the line to take is we need to reserve more gas domestically so that doesn't happen anymore.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the first thing we're going to do, as Dave said, is lobby your local MP to try and get some extra pressure on the gas prices. But assuming that's not going to work, Dave, what are the implications for assets?
Okay. I mean, if we do get this falling off for a while, then the first implication you would expect is a bid into bonds as the inflation bogey is killed, and then that kind of has a broadening set of implications for other asset classes. So, I mean, it's a funny old thing. We have, for the last kind of 3 years or so, had a negative correlation between bonds and largely between bonds and stocks, not within reason. And especially, the Mag 7 and tech, which are now so dominant in driving the stock market rally that's at all-time highs again today. That the sort of artificial intelligence trade that is at the heart of highly priced stocks tends to get more fuel when yields fall and vice versa. This is pretty typical of a tech rally because tech is usually seen as a kind of duration asset. So that is it can go through long periods of heavy expenditure in trying to develop IP.
Probably more. Can I put it another way, Dave? Got to put it in the way that tech is thought of as being this growth asset, and so if you're going to grow, if this thing's going to be worth a lot more in say 5 years' time, if you have a low discount rate, so a low interest rate and a low discount rate, then that's worth more today. So if I've got an asset, say that's worth $1 billion in 5 years' time and interest rate to 2%, then it's worth a lot more net to me now than the other way around. Than if we're looking at assets, if we're looking at it, say an asset that was worth the $1 billion in 5 years' time, but you've got interest rates of 10%, then all of a sudden that's worth a lot less in today's money because we can the discount rate coming back on that is much higher.
Quite right. So, I mean, the immediate conclusion to draw would be that we'd see a bigger bid into the Mag 7. That may not be the case, however, because when you get yields really coming down, capital tends to start chasing the higher risk stuff in tech, and so it starts to look at not profitable tech, and Mag 7's immensely profitable.
Yeah, well, and this is basically sounds like a similar setup to the whole tech boom, though, doesn't it? Like we had the Asian crisis, and that sort of scared interest rates and made everyone worried, and then we saw the Fed then lower rates and all that type of stuff, that sort of drove into that whole tech boom and helped to supercharge the upside. And so that's sort of, I guess, what we're arguing here, isn't it? Is that maybe we're looking at a similar setup.
So you could get a blow off in the Mag 7, but you're more likely to get a blow off in non-profitable tech, I would say, and that sets you up into a general kind of stock market blow off directly into the US election. In which they're debating furiously things like tariffs that'll be quite inflationary and more disruptive to globalization, etc. And so you could get a bit of a boom bust cycle coming out of oil falling here, where the whole tech thing gets massively overheated and then tanks into or after the election. So, well, these things are all very speculative, of course, but my base case is that the disinflation continues in the global economy and developed markets, and that does do this to the tech rally, and oil just exaggerates that as this AI rally pushes from somewhat reasoned to absolutely crazy, which is kind of my base case on where it's going to go before we kind of come back to earth and figure out exactly what is going to work.
Might just go quickly.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so thanks everyone for tuning in. We'll be back again next week, same bat time, 12:30 Sydney/Melbourne time. And I guess if you just for a quick reminder, we've got we're on all the different social media, all the major podcast platforms, and on YouTube as well. So thanks a lot for tuning in, and we will see everyone next week.